Hello, everybody. Welcome to another Finimize Live. Please uh, put your details in the chat. Let us know where you are dialing in from this afternoon or maybe this lunchtime if you're in the US. Let us know where you are and say hi to everyone else. We'll start in a couple of minutes. As you're coming in, we will launch a poll shortly so we can get to know you guys better. Please let us know where your primary focus is for investing this year. That will help us shape the conversation and other conversations to follow. Like I said, please introduce yourself in the chat and we will get started. So welcome to another Finimize Live, a very special Finimize Live. My name is Carl, I'm the VP of Content here at Finimize, and I'm delighted to host today's event, Investing Beyond AI in 2025, with our partner, Blue Whale. As I mentioned, please use the chat, let us know where in the world you are, say hi to everyone. Make sure you switch to all attendees so that everyone can see your message. In terms of how we're going to structure this session, Stephen and I will have a quick conversation for about 15 minutes, but then we will open the doors to your questions. So please use the Q&A box to lodge your questions as the conversation goes on and as things pop up. If you see a question you like, upvote it. If someone's stolen your question, upvote it. We'll get them answered as many as we can, as quickly as we can. But let's dive in. Firstly, just to introduce Blue Whale for those of you who might not know it. So Blue Whale Capital is a London-based boutique asset management firm, co-founded by Peter Hargreaves and our guest today, Stephen Yu. The firm is committed to maximizing consistent outperformance. Now, the Blue Whale Growth Fund is the firm's flagship strategy, launched back in September 2017. It's a long-only equity fund focused on large cap developed market stocks. Now, the team's approach is high conviction, valuation driven, and the aim is to construct a concentrated portfolio of high quality businesses. Now, with that out the way, I'm delighted and excited to have Stephen Yu, Managing Partner and Chief Investment Officer of Blue Whale, here with us today. He is an excellent guest to talk about investing beyond AI because last year we had him on the Finimize podcast, where he shared a ton of really valuable insight on how he's thinking about the AI space, where we might be coming to an end of certain elements of AI winners, and he's been ahead of the curve the entire time. So Stephen, Managing Partner, CIO at Blue Whale, previously worked at places like Hargreaves Lansdown, Janus Henderson, Artemis. He's got over 20 years of experience, the perfect guest for this conversation. Stephen, great to have you here. How are you?
Thank you, Carl. Thank you for having me.
Okay, well, let's dive right in. You know, Blue Whale has almost $1.7 billion in asset under management. You invest in a handful of stocks, 25 to 35, from all over the world. Let's start with your investment approach, Stephen. You know, what's the setup at Blue Whale? What's your worldview? How do you pick the stocks that you invest in?
So on a very high level, as you outlined at the beginning, we have been running the strategy for about 7 years now. And the aim for us have not really changed. I mean, we aim to maximize our performance in terms of where we invest into. And globally, we only invest into about 25 to 35 companies, and that's what we have been doing so far. And I think what has been interesting over the last 7 years journey or so is the opportunity set had been very different. Like since we started, we were heavily exposed to digital transformation names such as e-commerce, digital payments, digital advertising, cloud software. And of course, recently in the last 2-3 years or so, we've been mostly to do with artificial intelligence. So I think what's really important from a global equity manager perspective like us is we do have the ability to invest into the US companies, European, Japanese or UK companies. But ultimately the question is like, where can you find the best opportunities? And we do have a quality bias. We like high quality businesses and an attractive price. We do all the research in-house, etc. But ultimately, yeah, the question we will be asking ourselves is that where can we find the best return in terms of our investment opportunity set?
Absolutely. And I guess one question that I had when we first spoke last year that I want to bring to our members this afternoon, this evening, is around the tension between high conviction in your active strategy versus diversification in a more passive strategy. And I guess how do you think about that tension? Because if you've got really high conviction, is there a tension between picking stocks versus the received wisdom that you should be more diversified?
So I think if you follow Warren Buffett or Charlie Munger, they probably have mentioned that they would probably prefer to have all eggs in one basket, just in terms of they do understand their business really, really well, right? In terms of Berkshire, in terms of how Warren Buffett manages his own money. And then for us, I mean, equally, we have done a lot of work behind the scene in terms of every investment that we would make in the fund. I think the way that you think about this is also probably a bigger topic today. Why with I think most active managers are underperforming passive, and it just probably because they might be running too many stocks. I think typically when you look at the MSCI World Index as a proxy for the world stock market, there are about 1,500 stocks. And a typical long only global funds probably would have 100 stocks. We have about 25. But the way to think about this is like, how do you actually outperform the market, right? I did some work for last year, 2024. I mean, you can do it yourself too. That 25 companies out of 1,500 in the MSCI World Index would have accounted for two-thirds of the returns. So what it means is there's another 1,400 stocks within the MSCI World Index that hasn't done much or had been a detractor in the performance of the index, right? I mean, the index did quite well last year. It was up almost 20%. I mean, Blue Whale Growth Fund, we were up just short of 30. So then how do you outperform is you want to come up with a way to have fewer stocks to start with, to have the better name, right? Just imagine if 25 stocks did well in the index, and then you had maybe 5 to 10 of those 25 names. You don't need to have all of them. But at the same time, you have avoided the massive tail of underperformers, which the market has to have them in the index, right? That's what it called passive strategy. It cannot actually get rid of those 1,400 stocks. And so that's a way for you to outperform significantly if you do get things right. And the other thing, which I think is very important for people to remember as well, obviously, I mean, this is our day-to-day job. I mean, we do it professionally. We have a team of 5 to do all the work in-house, etc. But then for a typical investor, you probably don't invest into one fund. I mean, you probably have multiple funds, etc. And hence, you would probably have a lot more stocks to start with, probably in the range of a few hundred, if you do have an index tracker as well, than just 25 companies. So I think that is just like for people to consider. But I always feel very strongly about high conviction portfolio of companies, and it's better that investor would invest with high conviction manager rather than into diversified portfolios of many stocks.
That's a really clear answer. Thank you very much. You mentioned high conviction, so I'm going to have to come to one of your top 10 positions and possibly the most famous one, which is NVIDIA. Perhaps easy for everyone watching and listening to understand why. And you've been out there last year saying it's a stock everyone should own. But perhaps could you, given the topic at hand here is investing beyond AI, maybe let's just start with AI and then we'll move beyond afterwards. But can you help everyone understand, what was your thesis on NVIDIA and how has it evolved as we've seen this, recent advancement in AI tech?
So we got involved with NVIDIA only back in June 2021. So it wasn't that early. The strategy was launched back in 2017. So we were basically got involved about 3 years ago. And what was very interesting, of course, if you follow the journey of NVIDIA, that the share price went down by over 50% in 2022. That was the time that we actually took the opportunity to increase our position or to maintain our position. And hence, when the market cap surpassed $1 trillion in June 2023, we already had a very large position. And what was very different in terms of what we did to reflect the high conviction approach was not only that we did very well on the back of our initial investment, but at the same time was to maintain our very large position when Nvidia's market caps surpassed $1 trillion to $2 trillion and then to now more than $3 trillion. I think that does require a lot of conviction. Otherwise, then
Yeah.
you probably would have taken profits and move on to something else. So the reason that we did that or maintained that conviction was because I personally feel that generative AI is going to change the world. Just
Okay.
very simply in terms of our personal day-to-day, in terms of our professional context. Then the question about when is it going to change the world is the timing. Is it going to take a couple of years? Is it going to take 10, 20 years, etc., and some other stuff? But I have no doubt that it's going to change the world quite significantly on the back of the generative AI technology. So then what you really want to do, which is our view on this, is I think at the moment there's a lot of company trying to develop AI applications. So mostly the big tech personally, and now you have the Chinese, which just started the DeepSeek a model a few weeks ago. So we would welcome probably more competition within the AI application development space, which
Mhm.
then is a bit difficult to work out who's going to win. So when you look at the big tech companies, the Mac 6 outside, so actually net Apple, so Mac 5 outside of Nvidia and Apple, they are spending over $300 billion this year just to invest into AI. That's a very big number. And of course, from an investor perspective, is the question is like, how do they actually get the economics work? I mean, are they able to charge us the fee that they need to charge ultimately? At the moment, I think they're undercharging, including ChatGPT, the $200 subscription a month. So ultimately, it's about the price that they charge us, and at the moment, it's unclear whether they actually have the applications that we want to pay for. But what DeepSeek has probably introduced to the equation is that's going to be a lot more startup that can come into play. But one thing that's been very clear on the back of that, so using NVIDIA as the core of AI, at the same time Broadcom, which we have a very large position in that provide in-house GPU capability to the big tech, is that you would need to have the GPU compute to train your model to start with. And at the same time, you would need to do the inferencing on the back of what has been trained. And at the same time, you have the continuous feedback in terms of the loop that you have generated some output, and then that's probably not the most robust set of output, and you want to feed it back into the model, and then it kind of relearns by itself. So then all this would require GPU compute. And of
Yeah.
course, NVIDIA, just because they have been the pioneer of GPUs since what, 20 years ago, then they are at the heart of the GPU or AI compute domain, and so which is very important. But the one thing that I would say is that the outperformance potential that you would expect from NVIDIA going forward is going to be a lot lower than what we have experienced in the last 3 years, right? Like we would probably prefer Broadcom a bit more than NVIDIA, but it's not one or the other because you need both, because Broadcom is more for in-house GPU for the big tech. NVIDIA's GPU would be for the mass market, including the startups that's coming in, including DeepSeek, who was trained on NVIDIA GPU, etc.
Got you. I want to spend a bit of time on one of the things you mentioned. You talked about sort of the application layer and pricing dynamics being a potential driver. And I guess there's two questions I wanted to spend a bit of time on. One is around Microsoft, which has been an AI winner, granted, but nowhere near as much as NVIDIA. It had been a top 10 holding for you. It's not anymore as far as I can see, in that you've sold down a fair bit. To me, that's worth talking about. First question, can you maybe talk us through the change? Are you implicitly calling the top in terms of the AI application sort of rally without strong pricing? But I guess related to that, we've also seen literally today, reports around Microsoft pulling back some of its data spend, canceling some of its data center contracts. So if that is part of the thesis on Microsoft, or why you've become a bit less constructive, could that turn around relatively quickly if they reel in spending?
Yeah, this is a very good and important question just to dissect our view in AI today. So since I look it up, since we had the podcast in October last year, that we have changed our view slightly in terms of where we would prefer to be, which is more to do with AI infrastructure names such as
Yep.
NVIDIA or Broadcom that could provide GPU compute. And we have become a lot more cautious about company that's spending money investing into AI. So we do share with some commentators that there's a bit of a bubble in terms of the AI spending, right? I just mentioned the $300 billion being spent by the big tech companies. And in particular for Microsoft, which is very special for us because we have had Microsoft in the fund in our top 10 for 7 years consistently from September 17 until August 2024.
Wow.
7 years, top 10. I mean, we didn't have any other stock that have maintained a top 10 position for 7 years. But then we started to gradually reduce our position, and now we are just about to exit our position entirely in Microsoft, which is very significant, I would say, because it's a stock that did very well for us 7 years ago. Microsoft market cap was at only $500 billion. That's
Wow.
when we started investing into
Yeah,
Microsoft, right?
those were
So
the days.
now is the third biggest company in the world, over $3 trillion. So that something have changed. So what have changed in a snapshot was that the quality of Microsoft over the last 7 years has been improving on the back of a transition to cloud at the same time subscription model, right? So the margin profile of Microsoft has been expanding over the last 7 years or so. And of course, since we're now paying Microsoft, let's say $20 to $30 a month per user, as soon as you stop paying them, you no longer have access to the service, right? Your
Yep.
Outlook, your PowerPoint, your Excel, and some others. But I would say that the margin that they make on the back of Office 365 subscription is very high because the only thing they're providing to us would be the OneDrive storage, right? If you have your emails, your documents that you store in the cloud, that's what they probably do it for you, which is done on Azure. And I would say that probably the cost is not that high. Maybe they would have a margin of like 90% gross margin on that easily. However, on the back of AI, that they started to develop Office 365 Copilot, which is the AI equivalent, a bit of ChatGPT, a bit of automation, a bit of analytics within your Excel or PowerPoint to help you create presentations. That is a lot more expensive for them to
Yep.
produce that capability, right? So while they have also introduced a fee structure, which is to charge us $30 a month per user if you want that add-on, but I would suggest that the margin that they make from this product is a lot lower than the Office 365 subscription. At the same time, the business become more dependent on either NVIDIA GPUs or in-house GPUs, which is not the case previously. So what
Yep.
we're saying here is when we look at the valuation of Microsoft, it's very expensive in our view. I mean, it has actually underperformed the market last year and this year. So it has not actually been an AI winners over the last 18 months or so. I mean, it did very well in 2023, but not
Mhm.
since last year. And then the other thing about Microsoft is the margin is unlikely to expand going forward. I mean, we would actually think the return on investor capital profile for Microsoft is coming down from here. But what we are not saying, though, which is a very important point, is that Microsoft is not disappearing. It's
Yeah.
going to be with us for a long, long time. It will remain one of the biggest tech companies that are very sticky in terms of customer base, enterprise users, etc. But what we're saying is the outperformance potential from Microsoft is unlikely to be what Microsoft have delivered in the last 7 years. And we probably have other stocks that we think can do a lot better than
Got
Microsoft.
you.
And you probably can draw the analogy to Alphabet, maybe Amazon, a bit of Apple as well. And the only
Absolutely.
winners that we really like is Meta, which I can come back onto just because they have a lot of proprietary data about us, which is over 3 billion users of data through WhatsApp, Instagram, and Facebook.
Cool. Okay. Well, a lot to chew over there on Microsoft. Potentially, it's turning back into a money market mutual fund with a tech company attached, as it used to be described back in the day. But let's come on to everyone's questions in our remaining 11 minutes. Again, if you've seen a question that you want answered, please upvote it. Otherwise, please leave your question in the question and answer box and we will get through them. So first question here from S. Linda. Stephen, do you consider any of the Mag 7 stocks overvalued? If so, which? Which ones? By how much? And when would a correction occur? Okay, well, a fair bit in there, but I think you've given a view on some of those Mag 7 stocks, so maybe we can start there.
Yes, I would say that all of them outside of Nvidia and a bit outside Meta. I mean, I would say Meta is probably overvalued too. But then if you do take a long-term view, just because we probably would have some sort of AI avatar to replicate us through the data they have on us. So then you can take a long-term view on this, but short-term is all overvalued. The reason we say that outside of Nvidia they're all overvalued is because they are transferring a lot of their free cash flow to Nvidia's revenue or Broadcom's revenue, right? When I talk about the $300 billion worth of CapEx by the Max 7, Max 6 actually, that they is after free cash flow. So if we didn't have AI, that $300 billion of revenue would belong to shareholders. And when we look at valuation metrics, which is free cash flow yield, adjusted for that basically clear the free cash flow number. And that number have been transferred to the revenue of Nvidia and Broadcom, which is very interesting. So then my question to you is that which side would you like to be on? I would probably want to be on the receiving side that everyone would want to spend money with me to buy my product. Then the other side that you are spending money hoping that you would develop some AI killer applications that everyone want to pay for. But that's not a guarantee journey, right? You might work it out or you might not work it out. I mean, Google Gemini will be a good example that is Google Gemini going to dominate the GPT space? I mean, or is that Perplexity or ChatGPT or even DeepSeek is coming in to challenge that domain? So it's a bit questionable whether Google Gemini could be as successful as Google search for the last 20 years or so. So that's a question that you have to answer yourself. So to us, all the Max 6 are quite overvalued. But of course, then you have to think about, okay, in the current regime, that is a very challenging world, who can actually invest any money into AI? There are not many places for you to park your money. And at the same time, probably there's a lot of inflows from passive trackers. And then if you buy a passive fund, some majority of money would have gone into the Mac 6 or Mac 7. So then I think parking Nvidia, we do feel most of them are very overvalued.
Fantastic, really clear answer. The second question from an anonymous attendee, and I wonder if this is maybe about Palantir. They've asked, Stephen, do you consider stock-based compensation in your investment process?
Yeah, the short answer is we do. So when we look at free cash flow yield for valuation, we will adjust out for the stock-based comp from any companies.
Cool. Thank you very much. Are you concerned about a bubble in AI stocks?
I think we are probably just started the journey. I think we're quite relatively early in that journey, just because we haven't seen much yet from AI. So if you believe that all the AI application that we've seen today, like ChatGPT, image generation like Midjourney or Firefly, transcribing your conference call real time, summarizing an essay and doing bits and pieces, or chatbots, if you think this is the AI that we'll be talking about, then we probably got too many GPUs.
Yeah.
The AI that I would expect to come, which is under development at the moment, such as AI agents that are actually going to connect to the backend of any operating systems that can actually perform work for us.
Mhm.
And at the same time, AI avatar, which is basically to replicate us in a way that it can help you to perform certain tasks because it has learned a lot of things about you, what holidays you like, where you want to go for dinners, and there's a lot of things that you can get your replica to do it for you that have not yet started. But then when you think about like when I mentioned about Meta, like they have 3 billion users globally. So what it means is you can have easily 3 billion unique avatar for everyone. And that's a lot of compute, a lot of trainings, and a lot of use cases, right? So what it means is, in that sense, I don't think we're in a bubble yet, just because we haven't seen enough. There's a lot of potential to see it. But of course, when you look at valuation of some company, yeah, maybe there's a bit of a bubbly territory. But then it all depends on time horizon, isn't it? Because if you say to me the time horizon for some of these things to work is going to be 10 years, then yeah,
Mm.
maybe you don't want to buy now. But if you think, oh, it's coming in the next 2 years, which is quite likely, then you will be more comfortable for overpaying now because you know that in 2 years' time you'll actually see some kind of outputs from some of these
That
use cases.
that brings us very neatly onto a question from Katie, who asks if you have a view on quantum stocks, referencing Jensen's comments that we're 15 to 30 years away at the start of the year, sending quantum stocks tumbling. Uh, yeah, do you see them recovering? Are they the future? Is her
Yeah,
question.
it's a difficult one. I don't claim to be expert in quantum computing. I mean that recently there's been quite a bit of news flow from Google, who suggested they had a breakthrough, followed by Microsoft recently, and of course Jensen Huang have said that it takes a lot longer for that to work. But I think one thing is quite interesting, which I do believe this particular comment is that the generative AI capability today surprised a lot of people, a lot of scientists. What surprised them was that they didn't expect generative AI capability or large language model capability could have performed certain tasks, which
Mm.
they only thought maybe quantum computing was the answer to deliver those kind of problem solving. But they later on they realized that actually the generative AI large language model can equally perform a lot of those tasks. And hence, then I think what I'm saying here is, of course, I mean, at some point we're going to get quantum computing. It's probably going to be a disruption to NVIDIA's GPU because you no longer need the GPUs, right? It's a completely different ecosystem. But maybe we're too far ahead of in terms of the journey or in terms of when it's going to come. But at the same time, between now and then, there's a lot of things that the current capability could perform that
Yeah,
wasn't expected before. So
yeah.
I probably would give more credit to that than worry about quantum computing. I think what we really like for us from Blue Whale perspective, we want it now. I don't want to wait for 5 to 10 years to hope that something is going to work. I want it now, right? And hence I mentioned about Nvidia's and Broadcom there at on the receiving end. I don't
Yeah.
need to worry about whether you're going to be a winner in AI applications or not. I'm just making more money today than before I have to consider who is going to be the next winners.
And maybe just to, again, like since we set out the topic of investing beyond AI, and we spend a lot of time on AI. But Stephen, you're not just big tech or AI investors at Blue Whale, so I wanted to maybe close with a big picture question, considering the likes of PMI or Flutter that you also hold. So let's maybe spend a bit of time looking outside of AI. Are there two or three other trends that you're watching closely, and how are you investing in them?
Yeah, so without going into too much of the investment thesis, I would probably just list out those names. If people are
Yeah,
interested, I
sure.
can expand on. And so we like US sports gaming through Flutter in the US. Very idiosyncratic, not depending on Trump. Legalization of sports gaming is done on a state by state level. We like biologics. Sartorius, COVID vaccine was done on the back of biologics, and at the same time, with AI, there's going to be more potential for personalized drugs, and Sartorius would be at the heart of that development. And then we also have a defense company called Leonardo, which is very interesting, right? If you follow the dynamics about what Trump is trying to do, is to push Europe to be more independent
Yeah.
away from, let's say, the US support in terms of military power. So then it makes certain defense company very interesting in Europe. So this is nothing to do with AI. And then we equally like luxury. I mean, if you're thinking maybe the US, the China is going to maybe start to recover, maybe do a bit of quantitative easing or maybe relaxing some of the fiscal discipline, then
Yeah.
it could help too. And of course, I mean, Philip Morris is one of those stocks which is very interesting that you would think like this company is so boring. But then last year the shares was up almost 35% last
Mm.
year. And then this year it was already up like over 20%. despite everything that's going on. So within the last 14 months or so, the shares has gone up more than 50%
Oh my goodness.
in a space that you would think, okay, I need AI
Yeah,
company to make that, right? And it's done a lot better than your Microsoft, for example. And Philip Morris is one of those pioneers in smoke-free products, which we like to.
fantastic. That's perfect on timing. I'm afraid, though, that we have come up on our time today. So, first of all, thank you so much, Stephen, for sharing your thoughts, your insights. Fantastic work you're doing at Blue Whale. Fantastic ideas, as always. To everybody watching, please take a couple of minutes on your way out of the Zoom to let us know what you thought of today's session and what you'd like to hear more of. Thank you for joining us. Stephen, thanks again. Always a pleasure.
Thank you.